Hello, everyone. On today's edition of The Final Bar, my guest is Jeff Weiss, a longtime mentor of mine from Clearview Trading Advisors, going to give some long-term perspective on the markets, how this week fits into the big picture. Today, we have a nice run back to the upside. What does this mean for the big picture? We'll try to pick that apart. Also, in a segment, ETFs Engage, we're going to talk about factors and how the factors have evolved relative to this week's volatility. Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to our show today, The Final Bar. Thanks for joining us every weekday after the close to look at the markets from a technical perspective, connect the short term to the long term, try to get past the flickering ticks, and think about some of the long-term themes, the long-term trends. Make sure we're on the right side of things. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Today, it's going to be interesting after yesterday's, ignoring what the Fed did and thinking that the market was just going to go lower, even on good news. Today, we get the opposite. Today, we get back to the upside. We get the S&P up over 4%, healthcare leading the way. So it's sort of feast or famine, I feel like, day to day, which is way more volatile, way different of an experience than we've had up until the last couple of weeks. So what we're going to try to do today is try to put this into proper perspective. Think about what today's move means relative to where we've come from in the last 2 weeks. Coming up on the show, on the Final Bar and also on StockCharts TV, we've got some really good guests, some really good content. So tomorrow we'll feature Javed Mirza. Javed's from Canaccord Genuity based in Toronto. So we'll get a bit of a Canadian perspective to what's going on. On Monday, on Behind the Charts, which is one of our interview shows, we'll have Brian Shannon from Alpha Trends. He's an expert in multiple time frame analysis, did a really good job explaining how we should think of that in your investing. And then next week, we actually have some fantastic guests, familiar names and faces to many of you. Aaron Swenlin coming up on March 11th, Julius DeKempeter on March 12th. Coming up this weekend in New York is the Traders Expo. Unfortunately, due to all the news from Washington State, we had to cancel our trip out to New York, but we will still be doing our broadcast via live stream. So I'd encourage you to check out the Money Show website, look at the Traders Expo New York, do the streaming options if you're not able to make it there. If you are, should be fantastic. We're actually going to do some good Q&A with the crowd there here from Seattle. So a really good event. I'd encourage you to look into it if you've not done so already. So let's get to the market recap. Just think about what's happened. And again, yesterday felt like, all right, the market going lower, even on encouraging news from the Fed, supportive news, a sudden rate cut, unexpected, that has to be positive. And then we closed into weakness going into the afternoon yesterday. Today, we get the opposite. We get a gap up in the morning, sort of choppy going into the lunchtime hour. And then the afternoon was just slow and steady grinding higher. Pushed the S&P up above 3,100 to 3,130 to 4% higher. The Dow up 4.5%. So by any measure, nice strong update today. Mid caps, then small caps. That was the order. So large, then mid, then small. So again, we have that similar sort of feeling where the market does well, but it's led by the largest names. So for what it's worth, that's what we got today. This pushed the VIX lower down below 32, so we're at 31.74 going into the close today. Let's look at the chart of the S&P, and then we'll start to go under the hood and see what drove things around. So this is the chart of the S&P I've been looking at. This is the last 9 months or so. What we've been focusing on is this support range, or this demand area, what I would call it, between 28.25, 28.60 or so. This is based on the low from last week's sell-off, went into the low there just above 28.50. That lined up really, really well with the low from last October, and that's just above where we had last August, which was a couple lows there before we rallied out. So certainly an area at which buyers have come in before. That's where the market found support in an oversold condition. Now we've come back out of there, Yesterday was a distributive day by most measures. A lot of stocks had a bearish engulfing pattern. On the S&P, we had what's called the dark cloud cover pattern, which is a big up bar, a big down bar, and it closes at least 50% of the way down through the open to close range if you know your candlestick analysis, which should be bearish in the short term, but we rallied today. And technically, talking with Steve Nissen years ago about candlestick analysis, he always said the upper end of that candle, that 2-bar candle pattern, is always the exit strategy. So if we go above there, that tells you that candle pattern was not working and that you need to unwind it. So we actually got right up to that level. We didn't go past it. So by my read, that's still sort of active until we close get above that level. We'll have to see tomorrow if we get a follow through there, or if this was a bit of a, I don't want to say suckers rally because it certainly had some meat on it, but if this was just a short term rally before another leg down. It's interesting to note we've now reclaimed the 200-day. So day to day, we keep fluctuating right around this very important benchmark. And again, I look at the 200-day because I've worked with so many institutional investors that are very aware of where we're at relative to the 200-day. When stocks fade, or when they fail, or when they rally around the 200-day, people tend to pay a little more attention. So we're right about at the 50% line between the lows from August and the peak from last month, from February. Let's look a little deeper at the performance today to recap the market activity. Healthcare number one, followed very closely by utilities. So we have this situation where, the market going up, but it wasn't the leadership sectors necessarily being at the top there. We talked about biotechs yesterday and healthcare number one, but then it's utilities, it's consumer staples. So it's not really the traditional offense trade. Technology was actually right down there. Market performed about the same returns as the S&P 500. On the downside, you had energy, the weakest of the 11 sectors, still up over 2%, but far underperforming the market, followed by financials, followed by consumer discretionary. So, you have some sectors down here with financials, consumer discretionary, with communication services. These are sectors that I would hope would be doing well, actually, right? You'd hope that they would be thriving in this sort of environment. They're not, sort of leading the way lower. Down at some of the industry and ETF themes, so the S&P ETF up the most out of all of them. Looking at our universe, sorry, just resorting the list here to make sure. Yep, that's what I thought. And then after that, you have things like Switzerland, United Kingdom, so sort of traditionally defensive European indexes at the top there. At the bottom, India, Brazil. So Brazil, obviously, quite a tie to commodities, and any weakness there is going to be reflected there. Then some of the Asian markets, China, Hong Kong, et cetera, but pretty much everything up today overall. In terms of industry leadership, you can see healthcare providers number one, up over 10%. So that performance of that group is certainly going to drive healthcare as a sector to the top. You can see water as a group was number two. So that's a utilities group, number two out of 100 odd Dow Industries. That's why that group has done, that sector has done so well today. After that, actually a couple industrials groups, which is interesting. And then it's a mishmash. Things like tobacco names, which don't make a ton of sense being up so much today, but they certainly were. So it's a good reminder, just looking at what the market did and looking at some of the leadership themes. Some of these make sense, some of these not so much. So remember, don't ever focus too much on what should happen relative to the market. Focus on what does happen. That's one of the real benefits of technical analysis of charts, and especially of trend following, is that you focus on what actually has happened. On the bottom, we have aluminum names and marine transportation. Those are the only two groups that are down, but you also have things like E&P, oil equipment and services, coal stocks, all within the energy sector, sort of leading the way down. So certainly a lot of energy-related groups down toward the bottom of the return list today. We don't have time to get through all of the scooter rankings and what sort of fluctuated around, but I would point out there are a number of stocks that actually gapped higher today. So as you think about market leadership, you think about where the opportunities were. There are plenty of names like Anthem that gapped up really, really nicely, almost reclaiming previous resistance, getting back up to the 300 level, which would be pretty significant. Also a stock like Pfizer, and again, this is why healthcare did so well today. You have Pfizer really coming out of the depressed levels, coming out of the previous lows, retested support on a closing basis, never got below 33.50 before, and it just barely closed below there a couple days ago. This was Friday's close, if I remember right, coming out of the oversold region. You can see the relative strength just starting to turn up a little bit. So again, would be really interesting to see if healthcare as a theme sort of emerges a little further. When we look at the relative rotation graph, that's one of the groups that's actually not been as attractive. So it'd be interesting to see if we see further leadership there. That's our market recap for today. As always, I feel like with a short 30-minute show, we just have time to scratch the surface. So I hope you think of that recap that we do together as the beginning of a deeper process that you're able to do, really looking at some of these charts, looking at some of these movements, and looking for stocks that are able to break out of some key levels. We need to move on to our next segment, though, which is ETFs Engage. So one of the things we talked about looking at our show and how we're approaching things is to think about different asset classes. So we look at commodities, we look at fixed income, and we also talk about structurally some of the different ways we can break down the market. And ETFs are, a widely used, very liquid vehicle that that investors have used and advisors have used in recent years to get exposure to all sorts of different markets you never would have been able to get exposure to as an individual investor not too long ago. What we want to do with this segment is talk in particular about factor ETFs. We're going to look at some of the more liquid factor ETFs, what they are, how they've moved, and we're going to look at some of the relative performance themes and what that means for your overall exposure, how you should think of those related to some of the other bets that are out there. So in terms of what these are, remember with ETFs, you have exposure to different baskets of stocks. These factor ETFs, they all come from iShares. These 5 that I'm going to show you, all are trying to get exposure to certain investment factors. So technical analysis, generally, to take a step back, generally speaking, the idea is following momentums. The idea is that the market has memory, that trends exist and that trends persist. And so the idea with a momentum approach is that you're owning what has worked and you're not owning or underweighting what has not worked. And a momentum factor essentially is going to overweight stocks that have had strong performance over a certain look back period. And again, I'm generalizing to a great deal, but it's pretty much what it does. These iShares ETFs, these 5 that I'm going to show you, all are attempting to get exposure to a certain factor. They're not a pure exposure to the factor because, just based on the way that they're constructed, there's some other things they need to do to put it into the proper investment vehicle. But overall, does pretty well at giving you, serving as a proxy for what those factors are going to be. So going across from left to right, this is one of the lists that I look at. If you go to my morning coffee routine, this is one of the chart packs you can get. If you go to your dashboard, go to the chart list and go to the bottom, you can say manage chart packs, and you can get what I call my morning coffee routine, which includes this group along with all the other tabs that I tend to have at the top of my screen on the show here. But this is the way that I look at factors. It starts with 5 factor ETFs: the momentum factor, quality, size, value, and minimum volatility. Let's go through each one of those individually, and then we'll look at the performance of them as a group. So momentum, as I mentioned, is essentially trying to get exposure to certain a momentum factor. And again, broadly speaking, it tends to be something like own the strongest stocks over a certain look back period. For example, maybe the last 12 months. As you can see, on a price basis, certainly has come down along with everything else. Tested support around 116 here last week, and now has rallied back to the 50-day moving average. The relative performance is what's so important, though. Look at how the momentum factor has improved year to date. It had been one of the worst factors going into the end of last year, and then almost turned on a dime, as with many things, and has rallied very, very well. So it's been paying to own the stocks that have done well. The second factor ETF is quality, and this is basically, think of it as earnings quality, right? Stability. So these are companies that tend to be showing the characteristics of good earnings trends. As you can see, the price similar, and all of the prices are going to look very similar over the last couple of weeks, to be honest, because the sell-off was so wide and so broad. However, what I would focus on is the relative strength line at the bottom. So quality as a factor has actually been going down year to date. The next ETF, the next factor ETF is size. The ticker is size, S-I-Z-E, and this essentially looks at the smaller names versus the larger names within the universe. So think of it as owning the smallest X% of the S&P 500. The problem with this ETF is that it's been a chronic underperformer. So we've looked at charts looking at the relative performance of small versus large. We're going to look at the IWM later in the show, and that relative performance has been going down because the market has been led overall by some of the large mega cap tech consumer communications names. And that's what this line is showing you as well. Owning the smaller names has certainly not paid, even though over the long term it has. Here we have the value factor. This has been a bit of a polarizing one. Excuse me. With the value factor, we've talked a lot about growth versus value. People have speculated that, when the market started to pull back, maybe this is more of a rotation to a value orientation because growth has outperformed over so long. But if you look over the last 2 years, look at how this relative strength line owning the value ETF has hurt your performance on a relative basis, down about 15% relative to the S&P over the last 2 years, and certainly has not shown any signs of alleviating that. Finally, we have minimum volatility. So this is looking at different ways of slicing things up. These are going to be more conservative, more higher dividend payer, lower beta types of stocks. As you can see, this is actually rotated higher, and that's based on the fact that something like utilities has done well. That's probably going to make this factor look pretty attractive. So when you put all of these together, we get this sort of image. This is looking at year-to-date performance of the 5 factors. And just very quickly, and again, forgive me for not labeling these as clearly, but I'll walk through them together. In red, we have the momentum factor. So this is year-to-date here at the beginning of the year. You can see how it's rallied very nicely. In green, we have quality. This is earnings quality going down. In yellow, we have size sort of going down and to the right. In blue, we have value going down and to the right. And in purple, we have minimum volatility. So if we take this and look at year-to-date returns, makes it a little clearer. So momentum has actually outperformed the S&P by 6.5% just in the first 2 months plus a couple days of the year. At the bottom, over that same time period, value stocks, the value factor has underperformed by about the same amount, actually, about 6.5%. The rest of these are all in the middle, but only 2 of the factors have done well, minimum volatility and momentum. So what this tells you overall, when you're thinking about sector exposure, style exposure, market cap, all of that, think of these 5 factors as a way of sort of slicing the equity universe a couple different ways, other than sector, other than size, and seeing what's actually worked. And in general, this is said, good news, a technical analysis in terms of trend following still is kind of working. So stick with what has been outperforming. And in general, minimum volatility, the more conservative side of the markets overall, broadly speaking, has done pretty well. So that's sort of the way you can think about factors using ETFs. If you have questions about what I just talked about, just put them very quickly into the chat window or send us an email, thefinalbar@stockcharts.com, and we'll address it in a future episode. We need to take a quick commercial break. Back with my guest, Jeff Weiss. See you in a minute. Welcome back to our show, The Final Bar. Thanks for joining us every weekday here on StockCharts.com, StockCharts TV after the close to debrief on what's happened, try to connect the short term to the long term. And when I think about that exercise of connecting what's happening right now to the long-term trends, I think of one person. It's a mentor of mine who we happen to have on as our guest today, Jeff Weiss from Clearview Trading Advisors. Jeff, thanks so much for coming on the show.
One person, it's me, huh, Mr. Keller?
You are the one, Jeff.
Well, thank you for having me, you, Gretchen, and just all the people there in Washington State. Please take care of yourselves as well as elsewhere. God bless.
We appreciate it, Jeff. You sent 2 charts trying to help us get our heads around the last week or two relative to the long term. The first one was looking at the NYSE Composite Index. What is this telling you?
Yes, this is a broad-based average, David. And I like to go back. I like to go back a long time in this era of daily and 5-minute and second charts, whatever people want to do. I like to take an aerial view. And when I do that, I notice on the New York Stock Exchange Composite weekly bar chart a green horizontal line on which 3 down red solid arrows were situated. And you could see them there in the vicinity of 13,600 on the top of the green line, David. Right. And then if we go back after the rally above it to new all-time highs, the NYSE composite came back to test that area, I believe around 13,573 before rallying. And then on a huge downside gap, you'll notice how we not only broke that line, but we broke the blue line, which connects multiple intra-week highs, and the blue dotted line, which shows a low prior to a spirited rally through the green line to new highs. Now, what does this mean? To me, it suggests that after that recent low we had just above 12,000, that the vicinity, and I say vicinity, remember, technical analysis is not a science, it is an art. The vicinity of the blue horizontal line is roughly 13,260. That area, without really having built a base here, is where I would expect the odds to grow that we fail. And then a secondary investment target on an intra-week basis around the green horizontal line, which is in the vicinity of 13,605. And David, if we have time before we go to the next chart, I just want to say that in the 6 days ending with last Friday, it was rather amazing that this, in my 5th decade in this business, I cannot remember a time when over a 6-day period, the average net negative breadth per day over 6 days was 1,818 issues. That's, I mean, you want to talk, a figure that I don't even remember seeing it. That's amazing. And we also retraced 51 and change percent from the December 26th, 2018 intraday low to the February 2020 intraday high in only 7 weeks. And that reminds me of the collapse in 1987, where we retraced the gain from 1974 to 1987, which was around 51.7%, almost the same between August and October 1987. Just as an aside, to show you how much faster the market falls and goes up. And as far as the second chart goes, David, I wanted to mention that on the Wilshire 5,000 total market index, this is a closing chart. What is that, David? The weekly closing chart?
Weekly close, yep.
Right. I wanted to look for a line or lines, and I found a blue line that connects 3 regions. It's a well-defined line. It's fairly well-spaced. 2 points, two lows. I'm not big on drawing, trend lines with only 2 points. And I usually don't like to draw a line from a low or a high because the angle of ascent or descent is too steep. And I think it heightens the odds of getting stopped out or getting in at a, not an optimum area. Right. But when I looked at that line, David, and then I extended the line from that weekly closing low. When is that? Is that late September, David?
This year? One. Yep, that's right.
Yep. Notice how the low last week, the close, I should say the low, but the close was right in the vicinity of those lines. So to me, if you're saying to me, Jeff, where do the bulls have to make their stand? That is a line. And on any reactions, watch the number of stocks making new lows. I also keep tabs on upside and downside volume, and upside and downside issues as a percentage of total volume and total issues traded. I keep diffusion indexes, but I keep it simple, and I have spreadsheets where I write my work down. That is right, friends. I write it down every evening. So yes, I use the computer, obviously, but I come from an era where we didn't have this. And since the 1970s, I've been keeping daily and weekly tabs, writing things down. Kind of keeps me a little bit closer to the action, David.
Jeff, those are two fantastic charts. And when I think of you, I think of keeping it simple. You always reminded me to wait for the weekly close and get the signal from there. And this last chart, looking at the Wilshire 5000, is certainly something I hope everyone keeps in mind as we think about the coming days, coming weeks, whether we're able to retest the blue and the green lines. Jeff, thanks so much for coming.
David, thank you very much. And obviously, waiting for a week could be very, very trying. So, your listeners may want to also have certain daily parameters where they're not just waiting on an all or nothing basis for a weekly close. What used to take years now takes months. What used to take months now could take many weeks. Or what used to take many weeks could now, as we've seen, take a matter of days. Take care and God bless everyone. Thank you, David. Thank you, Gretchen.
Jeff, thanks again for coming on there. Folks, that's Jeff Weiss from Clearview Trading Advisors, someone who's had a pretty epic career in the financial industry. And I feel like so many things that I've learned about simplicity and trends and paying attention to price, I've learned from guys like Jeff. So such a pleasure to hear him. We need to wrap up the show, folks, though, with a 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these are not on your radar yet, I hope they are from this moment on. Chart number 1, the S&P by cap tiers. This is a frequent chart that we refer to. I have now color-coded all these breadth lines showing the negativity, right? So we've had now all 4 of them looking at the cumulative advanced decline line on the S&P, the New York Stock Exchange, the mid-cap index, and the small-cap index all breaking to new swing lows. Well, it certainly will uptick today. These aren't updated through today's close. You'd expect them to come up a little bit, but it's worth noting in the last couple of days, even with that nice jump higher on Monday, really didn't change the trajectory of this. Overall, the breadth picture has still remained relatively muted. So again, this is not a widespread, everything's clear. It's more of a bounce at this point until you get confirmation from some of those breadth measures, including others that Jeff mentioned earlier. Chart number 2, the Russell 2000. We've talked about small cap versus large cap. I just want to point out some of the interesting patterns you're seeing on the chart of the IWM, which is the Russell 2000 ETF. You can see we tested support around 144 last week. This actually lined up really well with a number of key support levels from last year, from last summer into last fall. What's interesting, that's actually a Fibonacci level as well. If you take the rally from the market low end of 2018 to the first quarter high there in February, we retraced 38.2% of the way. That ended up being the support, and that's actually where it lined up with where we just hit last week. So, talk about a line in the sand. And again, Jeff was talking about support on the Wilshire 5000. This is what I'm looking at on the small cap index. A break below 144 would certainly suggest further downside. And again, on a relative basis, it does not pay to go small at the moment. Last one, though, is utility. So talk about resilience of a relatively defensive sector. There have been periods, if you look back at 2014, it always comes to mind as a great example of where the market did well. Utilities was actually the #1 performing sector out of all the 11 sectors during that period. So just because the market is going up doesn't mean that certain sectors are going to outperform or underperform. It's all about tendencies. But what we're finding is in a time when yields are going down, when your bonds are paying less in terms of the overall yield, interest rates are going down, something like utilities with a healthy and consistent dividend on a total return basis especially starts to look pretty meaningful. And this is testing, a new 12-month plus relative high right about at that level based on the close today. So while the market is rallying, utilities are actually rallying even better. It's worth noting on the relative rotation graph, it's one of the few sectors in the leading quadrant. Ladies and gentlemen, that's our show for today on a Wednesday afternoon. Thanks so much for joining us every weekday after the close for the final bar. I want to thank my guest, Jeff Weiss from Clearview Trading Advisors. You can get all of our previous shows on our YouTube channel. Just look for StockCharts. You'll see them all there. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night.